The stock for Lemonade Inc., ticker symbol LMND, is currently trading at $60.08 as the market is closed, having finished the day on November 3, 2025, with a fractional increase of plus 0.11% from its previous close. That closing price, hovering right around the $60 mark, is not the most interesting piece of data, though. The real immediate insight here, the detail that should make any investor pause, is not the mild move, but the context of the price. Lemonade has just crushed its Q3 earnings expectations, and the stock is trading near its 52-week high, having delivered an actual loss per share of minus $0.51 against a consensus estimate of a loss of minus $0.72, coupled with a solid revenue beat at $194.5 million versus the anticipated $189 million. The fact that the stock did not soar wildly on the day of the news, but rather held steady after a recent substantial run-up, is the real story, setting up a tension between the clear operational outperformance and the market's surprisingly reserved reaction in the immediate aftermath. This suggests the market is not simply pricing in a good quarter, it's grappling with the core tension of the Lemonade thesis: impressive growth versus sustained unprofitability. The quiet close at $60.08 is the calm before the storm, as institutions and retail traders alike decide if this quarter finally validates the price premium or simply kicks the profitability can down the road. The common understanding of Lemonade stock, especially among retail investors who perhaps first encountered them through easy-to-use platforms like Robinhood or SoFi Invest, is that it's the disruptive online investment-style darling of the insurance industry. The narrative is straightforward: a modern, AI-driven, digital-first alternative to the stodgy, slow-moving traditional carriers. This expectation of a tech company disguised as an insurer is what allows the stock to trade at a premium even with persistent losses. The reality, however, is far more complex than just a sleek mobile app. This quarter's beat on the bottom line, narrowing the loss by a significant margin compared to a year ago, actually challenges the prevailing simplified narrative. The expectation is high growth, massive losses. The reality starting to emerge as high growth, faster improvement in core business metrics than anticipated. The stock's performance this year, up nearly 60%, has already factored in a lot of that growth optimism. But the narrowing loss ratio, a critical insurance metric that measures claims paid out versus premiums earned, suggests that the AI-driven underwriting is actually beginning to yield better risk selection over time. The company's core business model is about reducing the friction and the expense ratio, the cost of running the business, through automation and data. When they beat consensus on a loss figure by almost 30%, it's a powerful signal that the internal machine is becoming more efficient, which is a structural, long-term positive, not just a one-off beat. This shift in the loss dynamic is the single most important factor for the stock right now, overshadowing even the impressive top-line revenue growth of 42% year over year. Looking closer at the daily swings in trading volume before the market closed on Friday, we saw Lemonade trade within a fairly tight range of $58.77 to $60.95. This stability, coupled with the earnings beat, is key because the stock has historically been characterized by extreme volatility. A beta of over 3.0 confirms this high susceptibility to market fluctuations. When a highly volatile stock gets good news and doesn't immediately shoot to the moon, it often signals a cautious rotation or consolidation among institutional players, which is often a healthier sign than a momentary retail frenzy. Institutional ownership is high, hovering around 61%, a critical detail that indicates big money still believes in the long-term vision, despite the short-term bumps. However, the same institutional filings that show new positions, such as Privium Fund Management, recently adding a $7.8 million stake, also show activity like SoftBank reducing its position, illustrating a genuine split in the investment community. This institutional tug-of-war is what keeps the stock from having a clean breakout, and it's something an individual brokerage account holder should monitor closely. Volume has been elevated, indicating high transactional interest, a precursor to potential significant moves, which is unsurprising given the significant short interest in the stock. Over 25% of the float was sold short as of mid-October. An earnings beat that narrows losses acts as a direct threat to that short position, creating the potential for a powerful short squeeze if the broader market decides the profitability picture is turning. The core business of Lemonade is built on leveraging machine learning and behavioral economics to create a superior insurance experience, specifically for renters, homeowners, pet, car, and life insurance. Unlike traditional carriers, the company underwrites and processes claims using algorithms, a structure they claim provides lower costs and faster payouts, often in seconds. Their business model also includes the give back, a feature where unused premium money goes to a nonprofit of the customer's choosing, which acts as a powerful marketing and social impact tool. This structure, which replaces the agent and much of the bureaucracy with bots and AI, is what drives their low expense ratio and fast customer acquisition. The recent focus, however, has shifted heavily to Lemonade Car. The insurance industry knows that the car market is massive and highly competitive, and for Lemonade to achieve the massive scale that justifies its valuation, the car segment must succeed. The Q3 report confirmed strong growth in this area, with in-force premium continuing to climb. The future investment in telematics, using driver data to price risk more accurately, is how they plan to win. But integrating and mastering this data is a high-cost, high-risk proposition that requires substantial capital. This ongoing capital burn is why platforms like Fidelity or Interactive Brokers clients might shy away from it, preferring the stability of established insurers or funds like Fidelity ETFs or Fidelity mutual funds instead of a single stock with significant execution risk. The core risk for Lemonade stock remains capital management and regulatory scrutiny. Insurance is a heavily regulated business, and the ability to operate across various states and countries requires constant navigation of complex and often antiquated laws. Moreover, the business model relies on the accuracy of its AI to price risk. If a series of unexpected catastrophic losses were to occur, a major hurricane, or a prolonged period of high claims, the company could face substantial capital calls or solvency issues, something traditional insurers mitigate with decades of actuarial data and massive reserves. Lemonade has an active reinsurance strategy to offload some of this risk, but the efficacy of their relatively new AI-driven underwriting model hasn't been tested through a truly sustained, severe downturn in the insurance cycle. The intelligent portfolio approach of a platform like Schwab Intelligent Portfolios would likely underweight a stock with this level of volatility and unproven long-term profitability. Furthermore, insider selling has been observed recently, which, while not a definitive indictment, does add a layer of concern to the narrative of institutional belief. The high P/S ratio, close to its 3-year high, also suggests the market is pricing in a perfection scenario for future execution, leaving little room for error. The catalysts for the Tesla stock of the insurance world, a high-growth, high-tech, high-valuation stock, often compared to high-flyer growth names, are straightforward. First and foremost is the consistent improvement in the loss ratio and the move toward an adjusted EBITDA positive position. For Q4, management projected an adjusted EBITDA loss between $13 million and $16 million. Each quarter they narrow that loss, the stock narrative gains credibility, eventually moving from a story stock to a future profit machine. Second is the successful scaling of Lemonade Car and Lemonade Life segments, proving that the digital-first model can effectively conquer the most difficult and sticky insurance markets. Success here would confirm their platform's scalability beyond the initial renters market. The third major catalyst would be a large institutional validation, perhaps an analyst upgrade from a major bank that flips the narrative from a hold, reduce consensus to a buy consensus, which would likely trigger that short squeeze we discussed. Investors looking at Lemonade are fundamentally betting on the technological advantages, the AI moat, and the superior customer experience can eventually translate into lower long-term cost of acquisition and better than industry profitability. If they can demonstrate that their AI can consistently generate a loss ratio below 70%, that is the metric that will silence the skeptics. So where does this leave us in the expectation versus reality frame? The expectation is that Lemonade is a perpetual growth machine that burns cash, a high-risk gamble. The reality, as suggested by this latest earnings report, is that the high growth is not only intact, but the operational efficiency, The ability to underwrite risk and reduce claims payout relative to revenue is improving faster than the market expected. That unexpected speed of efficiency gain is the key insight. The company's management is deliberately prioritizing gross profit optimization over simply meeting a rigid loss ratio target, which is a mature and strategic way to approach the business. This strategy, while potentially causing short-term volatility, is the correct long-term mechanism for building a fundamentally sound insurance company. Now let's bring it to a point of engagement. Comment below what you think is the biggest long-term threat to Lemonade. Is it regulatory risk, competition from traditional carriers finally adopting tech, or their own ability to manage capital through high growth periods? Your answer will reflect how you view the fundamental risks of this type of online investing. When you look at your own self-investing choices, whether you use a platform like Fidelity Investments for its stability or Robinhood for its ease of access, the